This is Jerry Powers, your loan saver consultant. This is the second video in a series where we explore the options available to homeowners who are in danger of losing their home through foreclosure. But first, let's quickly review the options that are available. So what's the best solution for you? Is it foreclosure, deed in lieu of foreclosure, bankruptcy, selling your house, forbearance, refinance, a short sale or a short sale and leaseback, and a topic which we have already covered, the loan modification. First, I want to give you a little disclaimer here. First off, I am not an attorney, an accountant, or a financial planner. Therefore, some of what follows is my interpretation of the tax consequences of a short sale, which we will be discussing today. As always, please consult with an attorney and or an accountant for specific questions and or ramifications before proceeding with a short sale. So, what is a short sale? Simply, it is a pre-foreclosure sale that occurs when the lender agrees to accept less than the loan amount to avoid the headache and the expense of a foreclosure. So why would a lender agree to a short sale? If the lender has to foreclose on a property, it costs them money in many ways. They minimize their losses by agreeing to short sell the property. Some estimates have this cost to the lender as high as $30,000. So let's look at the benefits of a short sale. It allows you to sell your house for less than what's owed, therefore facilitating a quick sale. Helps you to avoid foreclosure on your credit. Allows you to stay in your home during the negotiations of the short sale. An investor or a family member can buy the short sale house and choose to lease it back to you. One caveat to this is, of course, you have to have sufficient income to be able to lease it back. And also another option with this is that in a few years you might be able to buy the house back for less than what you originally purchased it for. And short sale does not affect your credit score as harshly as foreclosure, and FHA loan holders can receive up to $1,000 at closing. Unfortunately, other loan types do not have this benefit. In a short sale, all other loan types, the homeowners are not allowed to take any money at closing. So question is, do I have to make up the difference between the loan balance and the short sale? In most cases, fortunately, the answer is no. However, there are some exceptions to this rule. First off, there's the deficiency judgment. Sometimes a lender will, after the short sale is completed, they will get a judgment against you for the difference between the short sale and what was owed. However, most banks do not pursue this because that's just simply throwing good money after bad. They figure someone who could not afford to pay their mortgage payment probably is not going to be able to afford to pay off this deficiency anytime soon. So therefore, it would just cost them more money to go after you. Or an unsecured promissory note. A little trick that sometimes a bank will or lender will pull on you at closing of a short sale is they will then hand you this unsecured promissory note and ask you to sign it before they allow the short sale to be completed. These reasons right here, the deficiency judgment and the unsecured promissory note, is very good reasons why homeowners should seek out the guidance and help of an experienced real estate investor, because an experienced real estate investor will know how to get past these two exceptions here. Another question, are there tax consequences for the capital gain? In most cases, no. The Mortgage Forgiveness Debt Relief Act of 2007, signed by President Bush, allows for the tax consequences of a capital gain to be forgiven for homeowners in their primary residence. However, this had to have been your primary residence for 2 of the last 5 years. Now that can be any 2 years of the last 5 years, and it doesn't have to be continuous 2 years. So stay tuned to this channel because we'll be exploring more of your